Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Michael Jones, and Michael is also a CPA. He is a partner in Thompson Jones LLP, and Jones is his wife, so the husband and wife team. They're located in Monterey, California. His tax consulting practice focuses on sophisticated wealth transfer strategies, trust and probate matters, and family business transitions. And I can say that Mike is the CPA that top estate attorneys go to with their tax and litigation problems here in Silicon Valley. He's done a lot of writing, so this is one of his books. It's called Inheriting an IRA. And he has created a version both for the public and for professionals. So if you want to get all the citations and everything, you get the professional edition. But if you just want more straightforward reading, get the other one. And you can get that online. And what's the website you go to get that?
Inheritinganira.com.
Okay, inheritinganira.com.
Or Amazon.
Okay, or on Amazon. Anyway, he's done a lot of other writing and contributed to the Pension Answer book, and he's the chair of Trust and Estates Magazine's Retirement Benefits Committee. He's been quoted in the New York Times, Forbes Magazine, Wall Street Journal, Bloomberg Financial Report, and others, and also he speaks at conferences, including the Kasner Estate Planning Conference that we have here in Santa Clara, and then also around the country. Mike also helped me with my own little book that I wrote, How to Use Roth and IRA Accounts, and he gave me some really good comments on that made my book a lot better. So Mike, thank you for that. Anyway, today we're going to talk about beneficiary designations for retirement accounts, including qualified plans like profit sharing plans, 401k plans, IRAs, and Roth accounts. And as we get started here, I want to caution our viewers that we're only touching the highlights of a very complex tax problem, and you can be aware, just so that you can be aware that this exists, so that then you can have a conversation with your own advisor. Also, I want to remind our viewers that only 10 states, including California, have community property laws, and the rules are different from state to state. And Mike and I are California CPAs. We're not lawyers. And so again, seek qualified tax and legal counsel for your own situation. So Mike, thanks again for joining me today. It's such a pleasure and something of an honor for me to have you here. Now, before we start talking about beneficiary designations, do you have any things that you might want to throw out related to some of the tax reform proposals that Mr. Trump and the Republicans have been throwing out there?
Well, when they talk about lowering the corporate tax, and when they talk about lowering the top rates on the individual tax, and when they talk about eliminating 3.8% Medicare tax on incomes over quite a bit of money, they have to pay for all those things somehow. Back in 1986, when President Reagan wanted to pay for lowering the tax rates to, what was it, 26%? They had to pay for that somehow. And at that point, that's when we got the requirement that we make distributions from IRAs after age 70 and a half and after death. So they used the retirement plans to help fund the legislation that they're passing. So it wouldn't be a big surprise if in passing any more legislation, they tried to tighten those rules up so that they could collect income taxes on retirement money sooner rather than later.
Right.
One such suggestion that came out in some legislation that did not make it through, but gives us some idea what they're thinking, is that anybody could have required minimum distributions for themselves after age 70 and a half. The surviving spouse could do it, or a trust for someone with special needs. Everyone else was going to get requirement distributions only on a certain amount of money, and beyond that, it was going to all have to be paid out in 5 years. So we may see a tightening of these rules as time goes on, but it remains to be seen if anything's going to get through this Congress in the way
Right.
of tax reform.
Right, yeah. So that's, I think Mr. Trump has found it more challenging than, in some ways, that he was hoping. Maybe didn't have as much of a majority in Congress as he was hoping for, but also the Republicans aren't necessarily falling in line, exactly, and some of their constituents may not favor some of the changes that they talk about. So we'll see. Everybody just sort of stand by on tax reform.
Well, as Mark Twain said, nothing is safe while the Congress is in session.
Right. Life, liberty, or property isn't safe. Okay. Well, why are beneficiary designations for retirement accounts important for us to be talking about today?
Well, they're very important for non-tax reasons to start with. When we all plan our estates, most of us set up trusts or wills and trusts, hopefully both. And we think of those things as putting our property in the right hands after we pass on. There are things that don't go through trusts or estates, and one of them are IRAs and retirement benefits. Life insurance policies are another example.
Right.
Those things have beneficiary forms that have to be filled out. And the beneficiary form answers the important question, who is going to get these assets?
Right.
So that's number one. From a tax standpoint, the beneficiary designation is going to dictate the metering, if you will, the regulation of distributions after death. If you name a surviving spouse as the beneficiary, it permits the surviving spouse to do an IRA rollover to her own IRA and treat it just as though it was her account all along.
Right.
So the beneficiary forms are very important both in terms of property rights and also tax implications.
Right. Okay. So I know in many cases, people may get one of these accounts, be a beneficiary, and their inclination may be to take the money and run.
Well, there is that.
And so why, what's the alternative to that, and why might it be wiser to take the alternative?
So my favorite way to frame that is it's really an overwhelming impulse to go ahead and remodel the kitchen, just as for example, or buy the car that you really.
It's interesting that you said that, because when my wife got her inheritance, that's exactly what we did.
There you go. So there's nothing wrong with that in principle, but when you're talking about a retirement account, it means you're going to pay all the income tax. So, yay, I inherited $250,000. Oops, it's only worth $150 because I have to pay income taxes on. So that's the rude awakening that we get when we actually do take all that money out at once. So what we want to do is we want to, first of all, educate our children on what retirement benefits are in terms of inheritances, and educate them that it's very advantageous to take those amounts out as slowly as possible. And I think if you ask any chief financial officer of any corporation, when do you want to pay the bills? And the answer is later.
Right.
Because the time value of money is worth something.
Yes.
Here you not only have the time value of money in terms of keeping money in the bank and invested, you also have the aspect of taxes, and it's always best to pay those later unless you really think they're going up.
Right. And by not paying the taxes, then you have more of a fund that you can use to invest, opens up more opportunities for alternative investments and so forth.
Yes, because what's inside the IRA grows tax-free.
Right, or tax-deferred.
Tax-deferred is a better word.
Yeah.
But you don't pay any tax on the earnings until someday you take them out.
Right.
So from that standpoint, education of the children is the first best offense. If you need a defense, the best one is to use a trust.
Okay.
So what we do is we go to our attorney who's doing our estate planning for us and ask them that we'll set up a trust which will take best advantage of required minimum distributions. and maybe make sure that they don't have access to take the IRA out until the age of maturity, somewhere around, say, age 50.
Okay, but well, yeah, we'll get into some of these details a little later. All right. Well, what happens if there is no beneficiary that's designated for the account?
Well, if there's no beneficiary designation for the account, it's usually taken care of for you, and you may not like the answer. For IRAs that are held with investment firms, and even some of the IRAs for banks, they will often go to your estate.
Yes.
The estate is the worst place for your IRA to go, number one, because now you have to open up an estate and pay all the costs associated with that. But number two, it has disastrous effects on required minimum distributions.
So maybe you can elaborate on that a little bit.
So if you die before you're 70 and a half, when required minimum distributions are supposed to begin, before your required beginning date, actually.
Yes, yes.
Your required beginning date for minimum distributions is April Fool's Day. That's the easiest to remember.
Yeah.
But it's the April Fool's Day of the year after the year you turn age 70 and a half.
Right, so you have to start taking distributions by that date.
Right. If you die before the required beginning date, the general rule is that the entire account has to be paid out and subjected to tax within 5 years.
Yes.
Now, the exception to that is if you have a designated beneficiary who is an individual or a qualifying trust.
Yes.
An estate is neither.
Yes.
So it can put you straight into that 5-year rule box.
Yeah, okay. So maybe you can elaborate a little bit more about trust, maybe a good candidate for retirement account balances.
So trusts do several things for us, but they also cost something to run.
Yes.
So the first thing you want to think about is, well, what size of a trust would you have to have in order to justify the cost and the complexity? And I hear people saying anywhere from $200,000 to $500,000. It may, however, be driven by what are the needs of your family. You might have a trust for a smaller amount just because you have someone who's too young, for example, to handle finances, or maybe has some special needs. So that's kind of the first thing that I think about when I think about the trusts. So then, if you are going to use a trust, what it does is it, first of all, lays out your plan for what you want for your money, which is why we all do trusts. Secondly, it puts a trustee who hopefully is a talented and dedicated person, someone who has the skills to be the trustee, maybe even a trusted family member who will hire a lawyer to help them be that skilled trustee. So now once you have a trustee, the trustee has certain duties. Those are called fiduciary duties.
Yes.
And those duties dictate that you have to administer the trust property for the benefit not of yourself, but of the beneficiaries. So there's that duty that means now you have to figure out what the right answer is and do it. So that's number one.
Yeah.
Number two, it places something in between the money and the person, like your children, that will basically meter and regulate what they're going to do, especially if they're younger.
Yeah. Okay. So as you were talking about this, I was just thinking, do you think that there are situations where it might be beneficial to have a trust for individual accounts or individual beneficiaries? In other words, like separate like you can, I guess, designate trust for Ann, trust for Bobby, trust for Sam, and as the beneficiary, and then this account can get divided at death, right?
So that's something that makes a difference for IRAs and not so much for other things.
Okay.
And the reason it makes a difference for IRAs is that the IRA required minimum distributions are based on the age of the beneficiary, what's called the designated beneficiary.
Yeah.
When you have a trust, the trust has to satisfy certain requirements or regulations in order to have an individual who will be a designated beneficiary.
Right.
If you don't meet those requirements, then it's just like leaving it to your estate as far as required minimum distributions are concerned. So you could, in fact, get stuck with a 5-year rule. So it's important to have a trust that's drafted in a way that will qualify for required minimum distributions.
Mhm.
Now, normally, if you set up one trust and it has several beneficiaries, the oldest beneficiary is going to be the driver when it comes to required minimum distributions. So, for example, we saw the Internal Revenue Service issues private letter rulings
Yes.
every year and answers questions that taxpayers have. And someone asked the question, okay, this IRA went to a trust, and there's a 67-year-old uncle, and there are a couple of kids who I think, as I recall, were maybe 10 years or younger. But anyway,
Mhm.
there was that big of an age difference
Right,
between them.
right.
And the question was, what age must we use for the required minimum distributions? Now that's an important question, because the 67-year-old has a much shorter life expectancy and therefore bigger required minimum distributions than the 12-year-old child.
Yes.
Well, the IRS said, according to the regulations, if you have several beneficiaries, you are going to take the oldest one. So the 67-year-old uncle is going to basically be the one who got it. Now, what could you have done to improve that situation? Well, first of all, give the uncle something else and set up a special trust just for the kids for the IRAs.
Yes.
Another thing you can do with your regular trust is when you do your revocable living trust, you can have the trust provide that there will be a subtrust for each of your 3 children, assuming you've got 3. And then what you do is your IRA beneficiary designation doesn't just name the trust as the beneficiary. It names the trust for Johnny
Mm-hmm.
as one beneficiary, the subtrust for Julie as another beneficiary, and the subtrust for Mary as the 3rd beneficiary.
Yes.
When you do that, then each of those subtrusts can use its own beneficiary for required minimum distributions. And in practice, what will happen is each subtrust will set up an inherited IRA, and each subtrust will take its 1/3 of the decedent's IRA into their subtrust. And then you go on from there. Each subtrust can use its own beneficiary.
Right. Good. Okay, well, what about designating beneficiaries for married account owners?
That's a very interesting question here in
Yeah,
California.
yeah, so we
Yeah.
now have a week-long series that we could do on this, but maybe we can just sort of hit some highlights here.
Sure. As Michael mentioned at the very beginning of our broadcast, California and 9 other states are community property states. Actually, one of them is elective. That would be Alaska.
Mm-hmm.
In a community property state, each spouse is going to own half
Mm-hmm.
of the community share.
Mm-hmm.
And I just did an hour lecture just on that subject, so it's a fairly significant subject.
Yes.
But what that means is you could name your favorite nephew as the beneficiary of that IRA, but your spouse owns half.
Right.
Your spouse is going to get half when you die.
Mm.
And it can be a mess.
Yeah. 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 So these are the types of things that might get us involved with litigation.
Hopefully we get involved in the planning stages.
It's
and
better
get
to
agreement.
talk about it in advance.
So what will happen with community property is you'll get asked to consent to a beneficiary form.
Mm-hmm.
So for example, if it's the wife's IRA, the wife needs to get the husband's written consent to name some beneficiary other than the husband, such as a trust or the children from the first marriage, or to give it to charity or whatever it may be. And when the husband does sign that consent, then there's the question of whether it was done according to California law.
Uh-huh.
So I do tell people in my practice that if you're going to do something like that, each spouse should think about getting a separate attorney
Yeah.
who will advise them each of what their rights are. And then they can do the consent form in that way. And now you've got a consent form file which is probably going to stick. Retirement money that comes from employer plans are generally almost always covered by the Employee Retirement Income Security Act of 1984. And
I think it
that
was 74, but that's okay.
74. Now I'm really dating myself, yes. What Jerry Kasner called the Geraldine Ferraro Act. 'Cause
Okay.
she was running for vice president back then.
Oh boy.
And it basically mandated that survivor benefits would be given in all of the employer qualified plans. And that is a very, very important law to take into consideration, to get counsel on.
So again,
when you're
just to
dealing with
reiterate that the spouse is sort of automatically the beneficiary. Yes.
Yes,
Okay.
automatically, unless the spouse consents.
Unless the spouse consents.
And so you really want to think about hard whether you're going to consent and why, and consider getting separate counsel.
Right. So one thing that comes out of this, and Mike sort of alluded to it even when we started, is that some of these assets, in some respect, are hidden assets. They're things that people don't think about. Like when you ask people to list their assets, quite often they won't list their retirement account because they just don't think about it. Because it's not something that they're accessing all the time. They might list their bank account and list their home and what have you. But there are some of these things that have value. I mean, we're probably talking about something that's your second or third most valuable asset at least. In many cases, maybe the most valuable. And it's not on top of mind. And so you really need a good attorney that's involved with your estate planning to be sure to tickle your thoughts related to this and to address those issues. Yeah. So.
I certainly agree.
Yeah. Okay. Well, like you said, you could talk about that for at least an hour and maybe more. So I think we'll move on. What should the spouses do related to beneficiary designation after a divorce?
After a divorce, you want to change a beneficiary as quickly as possible. Normally what will happen, what I've seen in practice, is that the divorce settlement agreement, usually there's hopefully a settlement agreement and it doesn't necessarily go to court, will award assets as between the two spouses. So there was a case that came down, it was a Supreme Court case from several years ago named Kennedy versus Plan Administrator.
Mm-hmm.
And what happened in that case was the marital settlement agreement basically said that the gentleman in the marriage, the husband, was going to keep all of his retirement benefits and that she wouldn't take any of those things. Trouble is that he never changed his beneficiary designation at work with the retirement benefits.
Mm-hmm.
So when he died, his surviving spouse said, "Oh, goody," and went after retirement benefits, and of course his estate and the spouse fought it out all the way to the Supreme Court. And the Supreme Court said, that plan is covered by federal law. It's an ERISA. That trumps your divorce settlement agreement. She's the beneficiary. Too bad he didn't change it. She gets the benefits.
Right. So when we talk about these things, well, did you want another thought?
I had a thought earlier that I wanted to say, and I wanted to be sure we get it in these last few minutes.
Go ahead.
Because of the importance of the beneficiary forms and because things do change, including people's addresses like the beneficiaries, I don't know about your kids, but mine have moved around a little bit.
Yes.
Okay? So it is very important to sit down and check your beneficiary forms on an annual basis. You should every year look to see, are they the right people that are going to get those things? Are they listed properly? Is their name current? Did somebody get named? Was there a name change? Did their address change? Did somebody die? Make sure you update those forms every year so that they are current when you want to do that. And the other thing is, don't count on the IRA custodian to call your beneficiaries and tell them they have rights. You need somebody in the family, or your attorney or your accountant, or somebody who will contact your family and say, you have something coming here.
Yeah. Yeah, no, this is very important. Like I said, these can be hidden. And part of the issue is the movement to paperless.
Yes.
Okay. So I had this happen recently with a family that I knew, friends of ours, and their son was actually a little younger than I, and he passed away. And his mother said, I don't know where, I know he had an investment account, I don't know where it was.
Wow.
I don't know who to talk to, and so, I suggest some people, one person that we know, in common that handles investments, that maybe he did, some business with him, maybe he can help, whatever. But, if you're paperless, then you don't have statements coming in, and so these things aren't apparent. And then if you're lucky, maybe you'll find a 1099 or something. Look at the tax returns, that can help somewhat, but during lifetime, who knows? So, anyway.
Where property winds up after 6 or 7 years is in the hands of the state. It's called a sheeted property.
Yeah, and it's
It's
immediately
very
taxable.
Well, no, it belongs to the state now.
Yeah, yeah,
So a sheeted property just basically sits there. There's no distribution. And if you don't claim it within a certain number of years, I think it's 7, but don't quote me, then it becomes the property of the state of California, whatever state you happen to live in, okay? I had a person who called me up who was an attorney, and he said that the paralegal in his office decided to just go online and look at a sheeted property in California and just check all the people in the office. And sure enough, he had a 6-figure IRA that his father had left
oh my God.
that he didn't know about.
Yes.
Then I got the call.
Oh yes. Yeah. So I think our viewers can appreciate, or I hope you can appreciate, this area of retirement accounts is really, it's quite a big area. And it's important that you have advisors that are familiar with this stuff, and also they'll write things down. So, you know, if you make a list of accounts that goes with your estate planning documents, because there's not always, it's not listed necessarily in your will or your trust. Sometimes the attorneys will say, make a list for your trust. But what if it's not going in trust? Okay, what if you just named a beneficiary? You need to write some instructions to your family about where things are, and leave that trail. Mike, we're about out of time. Maybe you can throw out a final thought and we can wind this thing up. But I want to thank you so much for being with me today.
I would say to pay attention to these things. Do take the time to sit down with your accountant and your attorney and go through all the assets. And if your children are old enough, prepare them.
Right. Yeah. Family council is an interesting idea to sort of talk about family finances. People sort of keep these things secret.
Mm-hmm.
Folks, we'll see you next time on Financial Insider Weekly.